Burton G. Malkiel's A Random Walk Down Wall Street brilliantly demystifies the complexities and risks of the investment world with compelling examples. The book argues that investors might achieve greater success by purchasing a broad-based stock index fund rather than attempting to pick individual stocks. Malkiel cites a striking example. A $10,000 investment in a Standard & Poor's 500 index fund in 1969 would have grown to $1,092,489 by 2018, compared to just $817,741 in an average actively managed fund. This difference highlights the low costs and high returns that index funds can offer. In an era of rapid financial innovation, Malkiel emphasizes the importance of exploring new tools and strategies available to investors. He sheds light on academic developments in investment theory and behavioral finance, advocating for data-driven strategies over emotional decision-making. This insight is particularly valuable for those planning for retirement. Malkiel asserts that stock prices are determined so efficiently that even a chimpanzee could select stocks randomly and perform as well as experts, a revolutionary perspective in the investment world. It's a well-known fact in the financial world that most professional portfolio managers are outperformed by unmanaged, broad-based index funds. However, debates about the possibility of beating the market persist. Malkiel offers practical advice to individual investors on how to perform better in the market. For instance, he emphasizes that your risk capacity can change based on your age and income sources, and that long-term investments tend to carry less risk. Essentially, if you're young and have a steady income, you can afford to take more risks, while as you grow older, a more conservative approach might be wiser. The book also delves into the random walk theory, which suggests that short-term changes in stock prices are unpredictable. Therefore, instead of relying on professional analysis methods or chart models, adopting a patient, long-term investment strategy may be more sensible. For example, long-term investors who did not panic and sell during the 2008 financial crisis were eventually able to recover and profit from their investments. Ultimately, this book serves as a guide for individuals pursuing solid, long-term investments over speculation. It offers tips on protecting investments against factors like inflation and increasing their value over time. In the investment world, taking strategic steps to combat inflation is crucial. Otherwise, our purchasing power might quickly erode. Investing requires knowledge and attention, like in Chekhov's The Cherry Orchard, where fortunes are lost due to neglect and ignorance. Knowing where you place your money is essential. Investment theory encompasses two main approaches: the firm foundation theory and the castle in the air theory. The firm foundation theory posits that the true value of an investment can be calculated based on future earnings and dividend potential. This theory forms the basis of successful investors like Warren Buffett. On the other hand, the castle in the air theory focuses on market sentiment. According to Keynes, investors seek to profit by predicting the market's psychological reactions. In reality, both of these theories are employed in various investment strategies. For instance, the internet bubble of the 1990s was a reflection of the castle in the air theory. However, such speculations are dangerous and often lead to significant losses. When investing, it's healthier to make informed, knowledge-based decisions rather than chasing short-term gains. The tulip mania in 17th century Holland is a classic example of how speculative bubbles form. Tulip bulbs, especially those infected with the mosaic virus, became extremely valuable. This virus caused unique color patterns on the tulip petals, and people paid hefty sums for these bizarre tulip bulbs. People began trading their land, jewelry, and even furniture for tulip bulbs, believing they would remain valuable forever. However, the rapid increase in demand and prices ultimately led to a crash. Tulip prices plummeted like a snowball rolling downhill. A similar speculative frenzy occurred in 18th century England with the South Sea Company. The company attracted investors with the promise of a monopoly on South Sea trade, but many of these promises were empty. People invested, thinking they could profit merely through speculation. However, when the market became saturated and the frenzy ended, many suffered significant losses. Both examples illustrate how people can abandon rational thinking in the pursuit of excessive profits. While speculation can yield substantial gains, it's crucial to remember that the risks are equally significant. One of the most striking examples of speculative bubbles bursting is the 1929 stock market crash, one of the largest collapses in Wall Street history. During that time, America was at the peak of economic prosperity, and stock market speculation had become almost a national pastime. As stock values soared, investors believed they could only win. However, that wasn't the case at all. Market manipulations were rampant during that era. Investment pools, groups formed to artificially inflate stock prices, were common. These groups bought and sold shares among themselves to make the market appear lively and bustling. Their aim was to draw public attention to this activity and sell off their shares as the bubble inflated. Unfortunately, when the bubble burst, many were left holding worthless stocks. Even renowned investors were affected by this crash. Geniuses like Isaac Newton fell victim to the unpredictability of human psychology. Following the crash, various legal regulations were enacted to regain public trust. Nonetheless, this event underscored the dangers of excessive speculation in financial markets. The 1929 crash remains a lesson in history and played a significant role in shaping economic policies. By the late 1920s, stock values had been inflated by speculative euphoria. During this period, closed-end investment funds traded at prices far above their asset values. For example, Goldman Sachs Trading Corporation sold at twice its net asset value. The foundation of such irrational investments was a blind belief that stock values would continue to rise indefinitely. However, this meant ignoring the lessons of history, and as a result, many investors suffered severe losses. By the 1960s, the stock market was once again shaken by a similar speculative frenzy. During the Tronics era, even companies unrelated to electronics tried to boost their values by adding electronics to their names. For instance, American Music Guild rebranded as Space Tone, causing its shares to skyrocket. During this period, investors focused not on what they were buying, but simply invested in names that sounded technological. These examples highlight the dangers of blind speculation in the investment world and how historical lessons are often forgotten. Smart investing begins with resisting the allure of short-term gains. Remember, learning from history is key to safeguarding your future financial health. The financial games on Wall Street in the late 1960s caused significant upheaval in the investment world. Conglomerates, the darlings of the era, appeared to grow rapidly through mergers and acquisitions. This growth led to rising stock prices. For example, the value of automatic sprinklers shares rose from $8 in 1963 to $73 in 1967. However, this growth was misleading. It wasn't based on the company's actual performance, but rather inflated through manipulative strategies and marketing tactics. With the collapse of conglomerates, investment funds shifted their focus to performance. Funds like Fred Carr's Enterprise Fund delivered high short-term returns, attracting the interest of investors. However, this success was unsustainable. Many companies faced real operational issues, and stock values fell. As a result, investors learned to be more cautious. In the 1970s, they turned to reliable, large companies known as the Nifty 50. However, even these companies saw their price-to-earnings ratios fall to reasonable levels, highlighting the dangers of speculation once again. These periods underscored the importance of caution and sustainable growth in the investment world. In the complex world of Wall Street, investors occasionally face significant disappointments. Barry Minkow's ZZZ Best Company symbolizes such a disappointment. Entering the entrepreneurial world at a young age, Minkow amassed a fortune quickly. However, the great success story was actually a tale of fraud. ZZZ Best wasn't just a carpet cleaning business, it was also laundering money for the mafia. Minkow used fictitious contracts and fake credit card transactions to show the company's growth. In 1987, this bubble burst, and Minkow faced numerous fraud charges. Japan's real estate and stock market bubbles also offer great lessons for investors. In the late 1980s, Japan's real estate and stock markets experienced incredible value increases. However, these rises didn't align with economic realities. When the bubble burst in 1990, Japan's stock market crashed by 63%. This situation demonstrated the importance of accurate assessment and showed that market bubbles always carry the risk of bursting. These stories remind investors to be cautious with newly emerging stocks and suggest that market bubbles can be prevented with realistic evaluations. Sustainable success in the financial world is built on solid foundations. Between 1998 and 2000, technology stocks formed a massive bubble. Investors thought stock returns would be between 15% and 25% annually. However, even giants like Cisco were trading at triple-digit earnings multiples, and these expectations weren't realistic. Cisco lost over 90% of its market value. During the internet era, many companies added .com to their names to increase value. But these companies faced valuations that didn't align with their core businesses, eventually rendering their shares worthless. For example, 3Com's Palm reached twice the market value of 3Com's total worth. Such anomalies highlighted the excessive valuation in the market. Additionally, many new ventures had unsustainable business models, like scent devices sold online or alternative currencies. The media also fueled this bubble. Investment magazines and online brokers sold investors dreams of getting rich quickly. Analysts ignored traditional valuation metrics, instead using concepts like eyeballs and mindshare for valuation. This overvaluation and speculation ultimately ended in significant financial losses. In A Random Walk Down Wall Street, Burton G. Malkiel exposes the complexities and risks of the investment world with compelling examples. During the internet bubble era, many people were drawn into the dream of getting rich quickly from stock market investments. At that time, media channels like CNBC presented stock market movements as if they were sports competitions, encouraging everyone to get ahead in the market. However, most investors suffered significant losses during this period. Terence Odian's research shows that many investors, especially those trading online, lost money even during the bubble. Meanwhile, the Enron scandal was a striking example of how dangerous speculative frenzy could become during this period. Enron executed a massive fraud by hiding its true financial status with complex financial structures. Such scandals highlight the need for investors to be cautious and always adopt a long-term, prudent approach. Ultimately, Malkiel emphasizes the dangers of succumbing to the allure of short-term gains in the investment world, while underscoring the importance of a long-term, diversified investment strategy. Being cautious when investing and learning from past mistakes is the most reliable way to protect our capital. In the financial world, credit default swaps, CDS, allow you to purchase insurance without holding the underlying bonds. This led to the derivatives markets growing much larger than the real markets, making the financial system riskier and more interconnected. In this new system, bankers and mortgage companies loosened credit standards. Previously, at least a 30% down payment was required for a mortgage, but the new system allowed for loans with no down payment. Ninja, no income, no job, no assets, and no documentation, loans became common, rapidly increasing housing demand and prices. The government's influence was significant as well. There was pressure to extend credit to low-income borrowers, inflating the housing bubble. Consequently, when prices fell, many people couldn't pay their mortgage debts and returned their homes to the banks. This situation was known as jingle mail. When the bubble burst, financial institutions suffered massive losses and some went bankrupt. As a result, the flow of credit stopped and the US economy experienced its worst downturn since the Great Depression. Markets generally correct their own mistakes, but this process can be slow and painful. New examples like cryptocurrency bubbles again highlight the complexity and risks of market behavior. However, the belief that the market will find its value in the long run still holds true. For Bitcoin to be accepted as a currency, it must fulfill the three fundamental characteristics of traditional currencies: being a medium of exchange, a unit of account, and a store of value. Bitcoin is somewhat successful as a medium of exchange, being widely accepted in transactions worldwide. However, due to its high volatility, it remains weak as a unit of account and a store of value. Its rapidly fluctuating value removes Bitcoin from being a reliable investment tool, turning it into a speculative bubble. Bitcoin's popularity, particularly in Asia, in countries with weak property rights and with government confiscation fears, has grown significantly. Despite this, its volatility remains a significant hurdle. The most important lessons from this book are: 1. Index funds over individual stocks. Investing in broad-based index funds often yields better results than trying to pick individual stocks, thanks to their lower costs and high returns. 2. Long-term strategy. Adopting a patient, long-term investment strategy is often more sensible than relying on short-term predictions and market analysis. 3. Behavioral insights. Understanding and controlling emotional decision-making in favor of data-driven strategies can lead to more successful investing. 4. Speculative bubbles. History is filled with examples of speculative bubbles bursting, highlighting the importance of cautious and informed investing. 5. Financial innovation risks. New financial tools and innovations come with risks, making it crucial to understand their potential impacts on the financial system. 6. Diversification and patience. A diversified portfolio and a long-term outlook are key to navigating the complexities and uncertainties of the financial markets.